And welcome back to another Econ podcast with Mr. Hagan. And on this podcast, we're going to continue to talk about investing. Please remember that this video is not designed to give investment advice. Its purpose is educational only. This video and other videos on this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. All right, let's get back to the educational stuff. And so far, we have talked about two theories of the stock market. The first theory that we talked about in some previous videos was we called firm foundation. And I would say, I'm just kind of guessing, making up a number here, but I would say probably something along the lines of 90% of Wall Street traders are probably firm foundationalists or have some basic belief in the firm foundation tradition. We are trying to look at earnings and dividends and P ratios and yields and figure out a company's intrinsic value and therefore determine whether or not it's worth buying the company. Number two, the second theory of the stock market that we've looked at in previous videos was called castle in the air. Castle in the air. And remember the castle in the air, if you remember from those previous videos, the castle in the air, I said they might make up like 10% of the traders on Wall Street. They just don't have the same kind of, scientific credibility maybe as the firm foundationalists would have. Of course, someone who's castle in the air would disagree with what I just said. So, I guess you'd have to form your own opinion about that. Now, you would say, well, Hagan, that's 100% of the traders on Wall Street. Who's left to believe in other theories? Well, the third theory that we're going to start talking about on today's video is called the random walk theory. That's kind of the layman terms. The academic term for this is the efficient market hypothesis. The efficient market hypothesis. And what I'm going to say is that these guys, the people who developed this random walk theory, these are not Wall Street traders like the firm foundationalists. They're not Wall Street Journal, not Wall Street traders like the castle in the air people. These guys are academics. These guys are coming from the colleges and writing academic papers on investing, and those would be the guys that would be getting the credit for the efficient market hypothesis of the random walk theory. And this is very much going to happen within the field of economics. So let's talk about what this random walk theory or efficient market hypothesis means. First of all, they're going to say that randomness, and this is going to be key to all this, randomness creates patterns. Randomness creates patterns. So when we were looking at some of those price patterns, like with the castle in the air, when we were looking at those price patterns and we were, we had a graph, this was on previous videos, we had a graph and the price was going up and down, whatever. And we were trying to find patterns in that. We were trying to find head and shoulder patterns, double bottoms, all that kind of stuff. Well, randomness also creates patterns. So the problem would be when you look at this graph right here and you would try to find a pattern, well, you don't know if that pattern represents something real. Is there something real going on that we have like a double bottom or a head and shoulders? Do those patterns represent, real things going on, real decision-making patterns by investors and so forth? Or are those patterns just created by randomness? Okay, it's just random, almost like flipping a coin. And so how do we know the difference between randomness, which would not help us at all, and something real that might help us? That's a fundamental problem that investors face. Randomness, if these share prices are indeed random, then they cannot help us predict future prices. They can't help us with prediction if they're random. So let's see what are the problems with the other theories. According to a random walk theory or an efficient market hypothesis, the problem with the other theories of investment were this. One, the firm foundationalists were trying to determine intrinsic value, which meant that they were trying to guess and that word now becomes really important, they're trying to guess what will be the future dividends and earnings of the company so that they can figure out what is the intrinsic value of the company and determine whether or not they're going to buy it. But of course, the future dividends and earnings of a company, according to the random walk hypothesis or the random walk theory, dividends and earnings in the future are themselves random. Okay? They're random. We don't know what dividends and earnings are going to be. We could do all the fancy mathematics we want, all the fancy analysis that we want, and at the end of the day, what we're trying to do is guess what dividends and earnings are going to do in the future. Well, those could be affected by all kinds of different things that we could never predict. Okay? A worldwide pandemic, a war starting, a lawsuit against the company, a new competitor coming into the market. These are just things that we cannot predict. Okay? And so therefore, we can't know what dividends or earnings are going to be in the future. Therefore, we can't know what the company's future intrinsic value is going to be. That's all going to be random. And therefore, we have no way of determining what stocks to buy and sell. The criticism of the castle in the air is, I already talked about this a little bit at the very beginning here, up here. The criticism of this is determining future share prices means following patterns. They look at these price patterns over time, look for those patterns, and try to use those patterns to predict what will happen to prices tomorrow. However, the random walk guys argue that those patterns may be random. And if those patterns are random, then they don't give us any indication of what prices are going to do tomorrow. So if I could sum up the random walk theory in one way, I would simply say it this way. The Firm Foundation and the Castle in the Air, they both suffer from the same problem, and that is they are both trying to predict the future. They are both trying to predict the future. They're both trying to predict which companies will do well in the future. One of them is trying to predict the future by predicting future dividends and earnings. The other is trying to predict the future by looking at price patterns. And I think a random walk guy would just say, hey, futures are hard to predict. No matter how fancy your mathematics, no matter how fancy your graphs, we don't know which companies are going to succeed tomorrow and which companies are going to fail tomorrow. We just don't know. And so it's impossible to buy and sell the right companies. Let's talk about what this word means, random walk. The term random walk is a mathematical term. It literally means a sequence of numbers produced by randomness, by a random process. Rolling dice, flipping a coin. These are random processes that could give us a sequence of numbers, of randomly generated numbers. But again, the problem is those randomly generated numbers create patterns. Okay? So let's just look at some examples to kind of drive home this idea. So let's imagine a real event, the new information that it generates, that it's random to us, and what it does to a change in share prices. So let's imagine almost any company that you owned. If somebody owned a company before the 9/11 attacks, the 9/11 attacks provided new information about that company's profits. And that is to say, we got the new information was that our country and therefore companies were less safe than we thought. They were less secure than we thought. Companies were less safe than we thought. And therefore, we found out that international trade and production and all kind of things like that were less safe, less secure than what we thought. And that information, here's the key, that information, I'm just going to rewrite this, that information was random to us. We didn't know it ahead of time. If I knew ahead of time that 9/11 was going to happen, if people knew that ahead of time, what would they do with their stocks? Okay? If they owned shares in an airline company and the day before 9/11, they knew that the 9/11 attack was coming, if they had that information, then they would have sold their airline stock. But see, the whole key is that the event was random. It was random. At least it was random to us. You would say, well, hey, it wasn't entirely random. There were a group of people that hijacked the planes and all that kind of stuff, and that was all planned out. That's true. But to all the rest of us, it was random. We didn't know that those events were going to happen. Those events were random to us. And here's the key. Once we got that new information, we then reevaluated how profitable that company was. We reevaluated how valuable that company was, and the share price went down. Okay? But the key is that new information, by definition, is random to us. We don't know what the new information will be tomorrow. Therefore, it is random to us. Therefore, this decrease in prices that happened is random. We don't know it ahead of time. We can explain it after it happens, but we did not know it ahead of time. Let's look at one other example of this. The company Apple develops an iPad. Okay? Before we knew that they developed an iPad, we didn't know it. This was new information. Once they announced the iPad, we realized that Apple was going to be a more profitable company. Okay? It was going to be a more profitable company. They were going to have more profits in the future as a result of developing this new product, the iPad. So they're going to be more profitable. But again, that piece of information was random to us. If it wasn't random, then we would have traded on it. We would have bought more Apple stock before the announcement, but we did not know it. New information is random to us, and of course, then this causes Apple's share price to go up. So what I'm saying is that the movement of these prices right here, going up and down, those price movements are random to us investors. Why? Because the new information was random to us. The information's real. Real things do happen in the world. The information was real. Okay? The event was real, but it was random to us. It created new information to us that we did not know before, and therefore caused prices to move in a random direction, at least random to us. So let me just sum this up. I apologize, a little long on this video. Let me sum this up. Random walk, efficient market hypothesis. You can't predict the future. Futures are unknowable. We don't know what companies' dividends and earnings are going to be in the future. We don't know what their price patterns are going to look like in the future. All real events are random to us because they generate new information that affects share prices. Okay? So the question then is, if we can't look at dividends and earnings, if we can't look at price patterns, then how do we know what companies to buy? What do we do as investors now? How do we make our investment choices? And those are some ideas that I will talk about on some future podcasts. All right, this has been Mr. Hagan on another Econ podcast. Thanks for joining me, and we'll see you on the next podcast.